housing shortage is not just an Arizona thing right now. But what is predominantly an Arizona thing is the amount of migration we've received and that we continue to get. Arizona stands out to people nationally. Outside of Arizona, Arizona is kind of viewed as, the place to go. A lot of opportunity here. So people want to invest here, and it makes sense.
Welcome to another episode of Kiss My Assets. I am Rocky Peterson, VP of Communications here at Neighborhood Ventures, and I'm sitting here with my good friend, Jamison Manwaring. He is the co-founder of Neighborhood Ventures as well as the CEO, which means he's in charge and he's a big deal. Welcome, Jamison.
Part of what you said is true. A lot isn't true, but I'm happy to be here.
Yeah, he is a big deal. Don't let him tell you otherwise. All right, so we're going to start off. We are doing a update on Venture on Country Club, and basically we get to dive in to some of the things that we know that investors are going to be interested in and that we're going to be able to tell them. But first, I'm going to start by saying, would you rather read a book or watch a movie?
Neither.
Oh my gosh, here we go. Well, what would you...
No, it's a good question. That's a good question when you actually have to think about it, because I'm not that big into movies. And nowadays, I would probably rather read a book.
Okay, what was the last book you read?
I'm reading a couple books right now. Roy Dalio, he's founder of Bridgewater. They're a big hedge fund. Principles. He's a pretty tremendous guy, and he wrote the book recently, and he's been in the business for like 40 years. So it was just kind of a reflective book. Love that. I'm reading, just started reading a book that I forget the name of the title, but it I won't get into it, but it basically talks about the 4 cycles of society, where there's times where there's growth and abundance, and then there's always times where there's not. And it kind of talks about historically how that works. And I forget the name of the 4th duration, something.
Okay.
Really interesting book.
Okay, so you don't like to read, but you're reading 2 very intense sounding books.
Yeah, I do. I don't love to read, but I love to learn. So I read to get through it.
So it's a necessary evil?
Yeah.
Okay, well, thank you. I am not reading anything quite so impressive. I read Apple News regularly.
That's good, though.
Yeah, I'm proud of it. Okay, so let's get into the Venture on Country Club. In broad strokes, what can an investor expect when they invest in Venture on Country Club? Broad strokes.
Yeah, so this is a project that we've already acquired. So some of our projects, when we're raising funds, we haven't purchased the building yet. This one, we've already purchased it because we've already reached our target. Our target was $2 million. We've already surpassed that. We're at about $2.5 million in total raised. The good thing about that is there's no uncertainty about us acquiring the building. We already own it. We're in the process of doing renovations. And for an investor, you get a 12% return, annual return. This is a 3-year projected time frame, so we expect to have the project completely renovated, stabilized, liquidated, all within the 3 years. And we begin paying distributions in December, a 6% distribution. So that's early, much earlier than normal. Normally, the first year there are no distributions. This one, it's about 3-4 months, and we start paying distributions. So in December, you'll get a 6% distribution right into your account. That's 0.5% a month, because we do them every month.
And then it continues to, the other 6% continues to accrue.
So yeah, then the other 6% is basically the upside when we sell the building.
Nice.
So 6% along the way, beginning in December, and then everything else you'll get at the end when we liquidate it.
That's awesome. And we found when we did Venture on 19th, one of the reasons that was so popular was because of that 6% distribution. And are there some properties where that just doesn't work? Like, what made Country Club that kind of possible, that we're able to do that early distribution?
The biggest thing is that the renovation is not extensive. So we don't have to go in and add plumbing and add electrical and do all these things that take a lot of time, get city permits. The building is ready to go. It just needs a facelift, mostly aesthetics. I'm talking flooring, paint, fixtures. So already the project has, and you've talked to John also, and he gives more details on that. But we've already began the demo. I think we're about 50 units in on the demo, and flooring's going in this week. Paint's already starting, exterior paint this week or next week. So stuff is happening. The reason why we're able to pay the distribution earlier is because it's a shorter type of renovation, a smaller renovation.
That makes complete sense. And I know that there were many investors that really liked that part of this. It's not a long hold period. It's early distributions, 12% annual return, and it's passive. And we've talked about that a lot. It's not passive for us. I'm on that property at least 2 to 3 times a week. Danny's there every day. But those aspects of our deals, that it's a shorter hold period, it's anchored by these quality assets instead of, just somewhere back east. And we find that people really like that.
Yeah, and we know what's happening in Arizona. People continue to move here. Housing continues to be a lack of housing supply for the demand. We're seeing this in our other projects. When units come up, the rents are moving up, and they're still getting leased very quickly. So the supply-demand elements are what's driving this. And in this case, we're taking a hotel that was kind of a lower end hotel. Certainly in the neighborhood wasn't a great shining star on the street.
It's our favorite kind of asset to make a shining star.
But it had so much potential. So we're going in and renovating it, turning it into housing rather than hotel. Everybody likes that. Everyone in the neighborhood would rather have stable residents rather than people coming and going. And it adds 120 units onto the housing supply, which we desperately need in the Valley.
Absolutely. So this is our first national offering. Well, how does that work with our local investors? Is there a difference for those that invest nationally? And how's it going?
Yeah, it's really exciting for us that we launched this nationally. And I won't get into too much of the weeds about securities laws, but in Arizona, we use an Arizona law, crowdfunding law, to raise the funds. Nationally, it's a whole different ballgame. You're working with the SEC, the Securities and Exchange Commission. So we are on an approved portal, an SEC-approved portal nationally that's called Small Change. They are a real estate portal. They have other projects on their portal. So it's not just ours. There's other sponsors. There's projects in San Francisco, Chicago, and folks can invest in any of those. So we put our project on their portal so that we can take national investors. The nice thing, if you're an Arizona resident, you can invest up to $10,000 in each project. Nationally, the laws are different. So typically you have to enter a little bit of information about yourself. You have to tell the portal how much you make every year, what your net worth is, and then it will tell you how much you can invest, what the government will allow you to invest. They don't want grandma to put all of her money in one project and lose it. So they're going to...
And that's why that's regulated.
That's why they regulate it. So even if something were to happen with an investment, they don't want people who don't have a lot of wealth who are investing, and most people invest whether they have a lot of wealth or not, and they want to regulate that to make sure that they don't put all of their eggs in one basket, so to speak. So that's how it works there. I think we're up to 12 or 13 investors there. We're beginning to do marketing nationally, and we've already raised about $300,000 on that side. So in total, we're just shy of $2.5 million between the two offerings.
That's amazing. And I feel like if I was someone that was looking on that portal and I'm looking at these projects and I'm basically investing alongside people who actually live there, who know a lot more about the town and about the climate than I do, it seems like that would inspire a lot of confidence. And it's just a matter of being able to get the kind of momentum that we've achieved here and visibility. I think that it's really fun, that idea that you're investing alongside local investors. It's a unique situation. Really
unique. I don't know any other situation like that. And obviously the people who live here are a bit more inclined to invest in Arizona because we see it. Right. But we also have friends and family outside of Arizona, and we tell them what's going on. Housing shortage is not just an Arizona thing right now.
Mm-hmm.
But what is predominantly an Arizona thing is the amount of migration we've received with COVID and that we continue to get. So Arizona stands out to people nationally. So when we posted our project on the portal, we got a lot of attention from the portal. They really wanted us to put the offering there because they wanted to have an Arizona offering. Outside of Arizona is kind of viewed as the place to go. A lot of opportunity here,
Right.
and we're here and we don't sometimes see that. But if you're sitting in Ohio or you're in, the Northeast or Midwest, Arizona is kind of like, wow, there's a lot of opportunity down there. And so people want to invest here, and it makes sense.
Yeah, absolutely. So John has his wheelhouse in the construction and real estate side in terms of an execution aspect on these properties. And your center's on the numbers. Can you tell me what those numbers look like for this project? Maybe some details in financing without getting too much into the weeds, but also kind of flesh out. This is a nice format to do that.
Yeah, and I think there's some important things that I think investors should understand about this. So the initial thing that really helps us to keep the risk of the project low is that we raise what we call interest reserves. So we have about 7 months of interest reserves, or basically our mortgage payment, tucked away. So we have 7 months. If you just compare that to your own life, it's always nice to have 6 months of your expenses tucked away. We have 7 months. And we do that because we're conservative operators. We don't like running things tight. We like to make sure that if something were to happen where there'd be a glitch, that we're going to be just fine. So having that interest reserve is a big thing. And investors, if I'm an investor, I think that's really important to know because it reduces your risk as an investor.
Sure.
The other thing is, as we start transitioning this property from a renovation property to a stabilized cash flowing property, what that looks like is we have about a year process to get this converted to an apartment from a zoning standpoint. And so we're not just going to sit with an empty property for a year.
Right.
So what we're going to do is we're going to operate it as a short-term rental. And this is a unique strategy that we're kind of a pioneer on. There are a few other people who are about the same stage we are. But with this hotel, the way it was ran, we didn't want to pick it up and run it that way.
Right.
We wanted to take the type of guests that we were getting and the type of rates we were getting and take them up a few levels. So we're not only are we doing a renovation, but once the renovation's done, we're going to operate it as a short-term rental instead of a hotel. So the differences are a hotel, you can show up on a Friday night at 8 o'clock and get a room if there's room available.
Right.
But there's somebody working on the front desk. You can't do that on a short-term rental. You have to book it in advance online. Typically, there's a 2 or 3 night minimum on a short-term rental. Most short-term rentals have kitchens. Most hotels don't. So you also attract a corporate traveler to a short-term rental that has a full kitchen that you don't at a hotel. You attract families who want to come and stay for a week or two because it has a full kitchen. So it's
right.
We're once the renovation's done, we're not opening a hotel. We're opening a short-term rental property, and that will only be transitional until we do get the full approval through the city. So our current time frame is we will begin having guests at the property October 1st, so about a month away from that, and we will the whole property won't be renovated by then, but we'll have a good section of it renovated. Most of the exteriors will be done, and we'll start having guests. What that means is cash flow starts coming in the door in 1 month.
Smart. Yeah. And I can see why we wouldn't want to run it as a hotel in that way. But the short-term rentals we have done before. We know we're good at it. And we're able to partner with other companies. We're not going to be running all the rooms. Is that correct?
Yeah. So
okay.
We could do that, obviously. But it's better to bring in a partner who is really good at the short-term rental business, especially at the level that we have. We have 120 units here. I've ran my own Airbnbs. If you have a guest house or a vacation rental, it's okay to run your own. It's not a big deal. But if you're running 120 of them,
again, you just don't like to run it too tight. You like to have a lot of things in place. Like you were saying, you want to conservatively, which means you spread that out a little bit, and it's not so labor intense on our part.
Yeah, and we bring in an expert who's really good at the short-term rental business, and we'll have a few partners on site operating and managing a section of units. That way we can manage the property, and basically by having a few partners on site, we'll be able to compare the results.
Yeah, absolutely.
And our partners are really excited to in October start operating units at the site. We have purchased furnishings from JW Marriott in North Scottsdale. They are going through a renovation process, so they had furnishings available. So we're bringing the furnishings there. You know all about this, Rocky, because you're handling this.
Yes,
and
I am.
You should talk a bit about that. But after we get the furnishings in, the partner comes in and handles all the linens. They handle all the kitchen. They handle the toilet paper, the shampoo,
all the amenities,
all the little tchotchkes, the sheet that tells you what you need, what you can do, and they do all that.
Right.
We do the property. We're putting furnishings in, and then they come in and do the rest.
Yeah, and when you were telling me, in order for this to make sense, and you laid out the numbers for me, in order for this to make sense, the furnishings need to cost this much, and I was like, well, that's impossible. That's just not possible. And as we kind of went through it, we were trying to decide, do we have them do all the furnishings and then they take a higher percentage? And that didn't make any sense. So I was like, okay, how can we furnish this for almost like an insane budget that you gave me? Thank you very much.
Yep.
Yeah, like Mission Impossible. And then I got into the industry of hotel liquidation, and a couple of really solid options, but they were in California.
And this only works if you have 120 units. So you can't
Absolutely.
go buy proper furnishings from a hotel if you're looking for a couple of rooms. You have to be buying in bulk.
Right. And so, but then we got into there was a little bit of a shipping issue. There was a little bit too much left to chance. And then I connected with someone who was liquidating this 5-star hotel, JW Marriott. It's like really beautiful furniture, and we worked it out. And so now all of a sudden, something that I was like, there's no way you can do it for that. All of a sudden, here it is.
Yeah.
And it's satisfying to have that come together. And it's also like encouraging when we're faced with some of these parameters that we find a way to make them work, or we pivot. And I think it's important to note that.
Yeah, and it's a big effort right now. If you go out to the property, we have probably 15, 20, 25 people there on a given day. We're now doing flooring. We have furnishings being stored on site in shipping containers. We have more furnishings coming. So there's a lot of moving parts to this.
Yeah.
But I can say I'm really happy with how things are rolling. John handles the logistical side of the whole real estate side. And Rocky's very involved in the furnishing side, and also inside the fixtures and the flooring and making sure everything comes together. So this is our biggest project, and so we're not it feels a little bigger, but at the same time we've done the exact same thing at a smaller scale, and so it makes it a lot easier to go up to 120 units when you've been doing this 9 times on slightly smaller buildings. And I'm really pleased with how the team is executing on our current plan, and we're pretty close to cash flow here in about a month.
All right, so we've heard your definition of wealth, so I'm just going to ask, what is your definition of success on this project?
Really, it is executing and doing what we told our investors we were going to do. So the first thing will be paying out that 6% distribution in December, because we have cash flow coming in. We're not paying distributions from thin air. They come from, our distributions going out to investors come from operating profit. So we got to have the revenue come in, cover all the expenses, the profit left over, and pay that out. We should be able to do that by December. I think another thing that will be a success is within a year getting it converted to an apartment building. We don't anticipate a problem there, although there will always be some work there. Mm-hmm. And we'll probably have to spend some time in the neighborhood. And we already have a lot of support in the neighborhood. They're really excited about what we're doing. But getting that completed, once that's completed, then transitioning it all to an apartment, long-term rentals. We won't have to do any renovations at that point. It basically just, as people leave from our short-term rental, we'll sign long-term leases. We already have our long-term leasing agent living on site. So she's going to be managing the property, all the maintenance. And then we'll just transition to leasing it up long-term. Once it's leased up long-term, that's really the big transition. And because then it is stabilized, we have an apartment building that's generating cash flow. And that's when we'll take a little bit of a sigh of relief. Until then, it's a lot of work.